So everyone who owns a 60/40 portfolio has exposure to Meta, and that stock fell 80% peak to trough in the bear market, which was like more than Bitcoin. It is true that Sol is generating about 2x the amount of MEV as ETH on a percentage basis. So it's 0.16% on Sol and about 0.08% on ETH. In that bull case, Ethereum's capturing a pretty sizable percentage of the value. So remember the take rates that I told you about right now, it's about 24%. We think they're going to fall to 5 to 10%. In the bull case, they're still in the kind of 8% range. So there, I guess we'd say that Ethereum in the bull case manages to hold on to its pricing.
Welcome back to our channel. Matthew Sigel begins by discussing the initial stages of Bitcoin ETF being introduced by bank-owned brokers such as Morgan Stanley, Merrill Lynch, and UBS. Despite the growing interest, financial advisors are currently restricted from purchasing these products unless explicitly requested by their clients. This indicates that Bitcoin and other digital assets have yet to be fully integrated into the mainstream investment strategies commonly dictated by chief investment officers (CEOs) who typically follow a 60/40 portfolio model, adjusting allocations marginally based on market conditions. However, there is optimism that Bitcoin might be incorporated into these models within the next year, albeit in small proportions ranging from 1% to 3%. This gradual inclusion aims to diversify portfolios while introducing clients to the potential benefits of cryptocurrency investments. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Our largest customers tend to be the bank-owned brokers like the Morgan Stanleys, Merrill Lynch's, UBS's, and they really are still in the beginning stages of introducing Bitcoin ETFs. The advisors are not allowed to buy those products unless the customer demands them. So these assets are still not integrated into the holistic investment philosophy, which is generally set by like a chief investment officer who has some type of 60/40 model portfolio and then is like adjusting tactically around the edges. And we're optimistic that some of those models are going to include Bitcoin over the course of the next year in the kind of 1 to 3% range. And we're trying to get kind of ahead of a potential diversification play by framing the Ethereum thesis. I think our traditional customers are still, some distance away from buying that, but that's what we have the next couple months, I guess, to educate them. But like I said at the onset, overall, the market for productive assets is bigger than the market for kind of inert commodities. And when we look at the type of performance that, and this really gets to the second part of the piece that maybe we'll talk about, but when we look at the performance of Ethereum in either versus Bitcoin or in a 60/40 portfolio, the type of return and risk that it introduces, there are some powerful diversification benefits, and the impact on the portfolio drawdown, meaning like how much you can lose, is relatively small. So I like to introduce this comparison to Facebook stock, ticker META, which is about a 2.5% weight in the S&P 500. So everyone who owns a 60/40 portfolio has exposure to Meta, and that stock fell 80% peak to trough in the bear market, which was like more than Bitcoin. And in our view, if we are correct that Ethereum is the open source app store, then it is going to directly attack the margins of a lot of these centralized Web 2 companies through a combination of technological innovation and a different regulatory regime. So we try to kind of compare the performance of Ethereum with the performance of things that our clients already own. And when they're presented with that data, the light bulb can kind of go off, and it's like, oh, this is not necessarily more risky than some of the things I already own. ETH would be capturing 90% of all smart contract value intermediation, and they would be collecting, let's see, in the bull case, so the penetration rates get pretty chunky. So Ethereum essentially accounts for 15% of the total financial markets, and then 50% of the advertising market hosted on open source blockchains, and between 20 to 25% of IT infrastructure and AI going through open source blockchains. So I'd say in that world, probably emerging markets are doing very well, and the US dollar is doing extremely poorly, and the US regulatory state has either like fully embraced open source digital assets, which I think is unlikely, or completely ceded them to other countries. And then in that bull case, Ethereum's capturing a pretty sizable percentage of the value. So remember the take rates that I told you about right now, it's about 24%. We think they're going to fall to 5 to 10%. In the bull case, they're still in the kind of 8% range. So there, I guess we'd say that Ethereum in the bull case manages to hold on to its pricing. Solana's larger MEV earnings are intentional, sustainable, etc. And I should have mentioned that the MEV take rate is one of the parameters in our ETH model. And we currently have it at about 0.1. That's the kind of take rate. And when you look at year to date, how much MEV Sol and ETH are generating, it is true that Sol is generating about 2x the amount of MEV as ETH on a percentage basis. So it's 0.16% on Sol and about 0.08% on ETH. So that's kind of the trade-off, is the shorter block times, the slightly higher degree of centralization on Solana creates more prospects for MEV, and it makes short-term trading more attractive. And that's why Solana has a kind of higher chance of becoming the NASDAQ of crypto in our view. And that thesis, I guess, is playing out along our expectations. If you read our report on Ethereum L2s from like a month or two ago, the precursors to this report are in here, like the Denkun fork lowering transaction costs dramatically, clearly has opened up a lot of white space for L2 applications, and the take rate that they're paying to Ethereum has gone down a lot. We just haven't really seen the demand materialize to soak up all of that new supply, and the MEV that's being generated is less on like a dollar for dollar basis than on Solana. So there's still kind of more work to be done, I guess I would say, but we're impressed by the execution on Denkun, at least.
Sigel delves into the mechanics of Ethereum and Solana, particularly focusing on minor extractable value MEV. He notes that Solana generates about twice the MEV as Ethereum on a percentage basis due to its shorter block times and slightly higher degree of centralization. This makes short-term trading more attractive on Solana, positioning it as a potential NASDAQ of crypto. Ethereum's recent improvements, such as the danksharding fork, have significantly reduced transaction costs and opened up new opportunities for Layer 2 applications. However, the demand to absorb this new supply has not yet materialized, resulting in lower MEV generation compared to Solana. Nonetheless, Ethereum's execution on technological upgrades remains impressive, highlighting the platform's potential for long-term growth.
There's like 7,000 Ethereum blocks a day. There's 216,000 Solana blocks a day. each block gives you these ordering rights, and winning the blocks is easier if you are really close, because you have this information advantage and you get to have the last say in that block bidding. But that advantage only works for the very last portion of the transactions hitting the block, say like the 100 last milliseconds. So if you look at the size of each block for Solana, a quarter of the block offers this latency advantage. And for Ethereum, it's like 1/100th. So you get more surface area on Solana to get this latency sensitive MEV, and more chances to get it because you have more blocks. And so I think the so what is that the short block times give lots of instances where someone with great latency can take advantage to better rearrange the blocks. And that has a somewhat centralizing impact because the best builders win. And I think it explains why MEV is such a larger percentage of our revenue line for Solana than it is for Ethereum. So in our SOL price target, MEV comprises roughly 2/3 of the revenues, and for ETH, it's closer to 1/3 or 35%, and that's by design. Like, one is not necessarily better than the other. It's trade-offs. The parameters are the size of the markets that Ethereum can disintermediate. And so that starts with like just the top line revenue for these sectors: finance, marketing, advertising, infrastructure, AI. And that sums currently to about 13 trillion in addressable revenues that Ethereum can go after. The second parameter is the market share for crypto overall. What percent of those revenues can they actually disintermediate? And those numbers, depending on the sector, range between 5% and 20%. And in our base case. So this is not a scenario of mass adoption. Even in our base case, the penetration rates for crypto are relatively low. The third parameter is Ethereum's market share, which we assume for all of our base cases, because this is a kind of winner-take-all world, that the number one chain gets about 70% market share in the base case, 90% in the bull case. The next parameter is the value capture. So how much does the Ethereum ecosystem actually keep of all of that, call it transaction value? That number is between 5 to 10%, depending on the sector. And then, we have to pay away some costs to validators. We assume that all of the profits are taxed at 15%. We have to arrive at a terminal ETH supply, which is kind of tricky to do. Our base case is 100 million. And then we apply a terminal multiple of earnings, or in this case, free cash flow that an investor would pay. And we use about a 3% free cash flow yield, so 33 times free cash flow, which is comparable to a reasonably fast-growing software company. So those are the parameters. What that ends up with is that we forecast that the Ethereum network will generate $66 billion in free cash flows that accrue to the ETH token. And when you multiply that by 33 and then divide by the 100 million coins, it's 22,000 per coin.
Matthew Sigel's analysis provides a detailed and optimistic view of the future for Bitcoin and Ethereum in traditional investment portfolios. While Bitcoin ETFs are still in their infancy, there is a growing potential for Bitcoin and Ethereum to be integrated into diversified portfolios, offering substantial benefits with manageable risks. Ethereum, in particular, presents a compelling case for significant market penetration and long-term growth, challenging traditional tech stocks and centralized platforms. Please like and subscribe my channel.